Nicholas Bornos of Capital Link. I'd like to welcome you to yet another panel of great interest. This one is going to talk about ship finance, the ship owner's point of view. We had before another panel that provided the financier's point of view. So now we are going to discuss with 5 CFOs of major shipping companies how they look at the overall landscape of ship finance. So I will thank all of you for joining. And Jasel, the floor is yours. I will let Jasel to introduce the panelists. Jasel is a partner, the head of the finance practice at Dickinson. So thank you very much for moderating the panel. And Stavros, Simos, Apostolos, Ted, and James, big thank you from me. And Jasel, the floor is yours.
Right, thanks very much, Nicholas, and thanks for the introduction, and also, as usual, the very kind invitation from Capital Link. I think Nicholas let the cat out of the bag and mentioned that I'm a lawyer, so I'm immediately the least interesting person on this call. But thankfully for our audience and viewers, we've got an excellent panel to make up for it. So just to briefly introduce everyone. It will be a bit scattered because I'm sure that we're on different parts of the screen for different people. But first off, we've got Simos Spyrou, who's co-CFO at SBLK Carriers. We've got James Doyle, who's head of corporate development and investor relations at Scorpio Tankers and NETI. We've got Stavros Gyftakis, who's CFO at Seanergy Maritime Holdings. Apostolos Zafolias, who's CFO at Genco Shipping, and we have Ted Young, who's CFO at Dorian LPG. And before we dive straight into the questions, I should probably set the bar low by mentioning that we are actually at the post-lunch slot for New York. We're at the dinner slot for Athens in Greece. So hopefully that will help us to set the bar low. We'll have to keep the conversation interesting and try and avoid any indigestion from those who've just had lunch. But moving on to the first question, with that in mind, what we'll do is we'll set the context a little bit, the current market, and we'll have each of our panelists kind of give their initial input on the prior financial year and how they see things to come for 2022 in terms of ship finance and capital requirements and also capital markets. So just to set the context of that, you know, it probably goes without saying these days that things in shipping are never dull. Hot and cold markets for different sectors, some booming markets for some sectors. COVID vaccines in 2021, stabilizing world markets, recovery taking hold, vessel values improving, lots more liquidity, and then war starts in Europe. Oil prices reaching record highs, Russia excluded from the market through sanctions, and the latest being that large parts of China are going to be going into very strict lockdown. So, as I said, never dull. But on that topic, just to give a kind of intro for each of our panelists in terms of how they did view the prior financial year, which is probably a task in itself, perhaps even just looking back at the last 3 to 6 months, and then how they see the 2020 developing. Stavros, you're in my top left-hand corner, so do you want to make a start on that topic?
Sure, Jasel. Good afternoon to you and to our fellow panelists. A big thanks to Nicola and Capital Link for hosting our panel. Yeah, I'll start on a positive note. I'll start with 2021, which was indeed a very good year for dry bulk and for Cape sizes, which is Seanergy's niche. Rates hit indeed multi-year highs. We averaged above 30,000 for the year, and we generated basically record profits. And most of us were able to reward our shareholders by initiating or paying out large dividends, which we aim also to continue doing forward. Now, on the corporate finance front, in the beginning of last year, we moved quickly. We priced a follow-on, a registered direct offering at I would say, an attractive valuation, considering the NAV of the company back then. Then we deployed the capital accretively, mainly to support I would say, well-timed and aggressive, considering our scale, fleet expansion program. We grew by around 70% from 10 vessels in 2020 up to 17 vessels in 2021. We also, got the chance to deleverage the balance sheet. We paid down debt, and we financed the new vessels that we bought very conservatively or with equity only. Now on the debt side, because it's basically a ship finance panel, we did a bit of everything. Last year we did traditional bank lending, where we got lots of support from and renewed interest, I would say, from local banks, from Greek banks. They have returned aggressively in the market, and they have ample liquidity to support our industry. We closed a loan with a Taiwanese lender, also a nice niche that's developing over there. That was their first Cape-size financing ever, and they chose us to transact with, given our pure play model. And then we did also leasing with Chinese and Japanese counterparties. Also a couple of transactions with ESG flavor. We did a sustainability linked loan with one of our Greek banks. And it's encouraging to see that Greeks, I mean, the more traditional, or I would say old school shipping lenders, they are exploring these structures as well. And we did also a synthetic sale and leaseback with one of our charterers, with Cargill, which has an embedded time charter agreement with built-in funding for the installation of energy-saving devices on the specific ship. Now, looking ahead, indeed, what's happening in Ukraine, it's I mean, leaving aside the very sad humanitarian aspects, is causing uncertainties in our markets. We're trying to adjust. We see more established trade patterns that are being gradually replaced by longer ones, less efficient ones. Now, usually these kind of disruptions, they eat into the vessel supply and result in higher day rates. So we are being cautiously optimistic for the day after tomorrow, but for the time being, we'll have to live with the volatility that we're facing. Now, in terms of funding needs, Seanergy, and I think most of the dry bulk players out there, we are in a good place. At this rate, we're still making money, we're still profitable. We have also some nice hedges that we're carrying over from previous quarters. And on the loan side, I would say, I mean, we did more than 170 million in new financing and refis in 2021 and in the beginning of 2022. So we are not faced with any loose ends, really. We have a couple of a small balloon on 2 ships, which I expect, I mean, to refinance with no issues, judging from the interest that we get from the lenders. And in terms of capital allocation, I think we will continue on the same mix. I mean, rewarding our shareholders through dividend distributions, potentially some buybacks, depending on how the share price develops. And maybe we're going to pick up a couple of ships more. Second-hand prices for Cape still do make sense, which will finance basically through cash that we have on the balance sheet and senior debt, or some debt on existing ships that we have that are debt-free. And that's it for Seanergy and for the Cape-size sector.
You covered a lot of topics. I think I want to come back to probably a number of those, but I'll keep quiet for now, and I'll pass the same question and topic on. On my screen, it comes across to you, Simos. So if you'd like to have a go at that topic.
Thank you, Jasel, and thank you from my side as well to Nicholas and Capital Link for hosting us tonight. Indeed, I agree with Stavros. 2021 was obviously an exceptional year, with freight rates being very strong across all vessel classes in our segment in dry bulk. From financing perspective, we have executed a 400 million refinancing program during 2021, reducing our interest costs substantially, including also retiring actually our 50 million baby bond, which had a coupon of 8.3%. We also entered in swap agreements for some of those new facilities, which actually are proving valuable during 2022 with rising interest rates. Overall, we have about 55 to 60% of our debt hedged through swaps at an average cost of approximately 46 basis points. So we have taken steps to reduce our exposure to rising interest rates environment significantly. During 2021, we managed to reduce our overall interest costs by approximately 20% vis-a-vis the previous year. And this has not taken into account the full effect of the 2021 refinancings. We have currently 6 vessels that are unlevered after completing the refinancing program, and we do not have any debt maturities for the remaining of 2022 and the first 3 quarters of 2023. Starbuck is currently a great credit for all financiers, and we have many financing options in our disposal in order to further reduce interest costs. We are evaluating them, and you might see us doing more refinancings in the near future to reduce further our interest costs. Any new vessel acquisition can be financed at very competitive rates, or even you might even see us buying vessels without any debt as a part of our deleveraging strategy to gradually reduce our corporate debt on a corporate level. Deleveraging may be a way to cater for uncertainty in this environment, and I agree with Stavros that it's very unfortunate what we are lately seeing with war in Ukraine and this turbulent geopolitical environment. And we believe basically that the only way to cater for this uncertainty is basically to further strengthen your balance sheet and reduce debt, which will make stronger the overall credit.
Great, thanks, Simos. Apostolos, you're next on my screen, if you'd like to jump in there.
Yeah, sure. I think that the other guys covered the dry bulk story. I think that the one thing to note is, part of the strength of this market has been due to a historically low order book at close to 6%. That's one thing. I mean, obviously the demand side is great, but the low order book is something that we haven't seen in over a decade, and as I said, the all-time low was 6%. So I think that is a good base for fundamentals going forward as well. Obviously on the industry side, agreed on the events in Ukraine. Past the humanitarian aspect, they have actually sort of benefited the dry bulk trade, at least for now, specifically in terms of rerouting flows for both grains and coal. The grain side is a little bit more uncertain going forward, but on the coal side, you're seeing a clear differentiation of a clear rerouting of cargoes that would normally go out of the Black Sea and into Europe, now being redirected, and Europe getting coal from Australia a much longer ton mile. So, the combination of factors, again, always underpinned by the lower supply side, has provided a good background for us industry-wide and hopefully going forward as well. Genco specifically, for the past year, I think both Simos and Stavros mentioned it. We concentrated on delivering the balance sheet to further strengthen the tech company going forward. In April of last year, we announced a new capital allocation strategy. And as the first part of that strategy, we concentrated on paying down the debt so that we can reduce break-even levels. Some of the peers started paying out dividends ahead of us and set the path for us. So thank you for that. But we wanted to sort of make sure that we have we focus on sustainability in general, not sustainability just on the ESG side, but sustainability of shareholder returns going forward. What we found is the only way to do that is reducing the break-even levels down to a level that will allow you to pay dividends throughout the cycle, so that you don't have to turn them on and off and lose the potential valuation impact from them. On the debt side, we did a big refinancing of $450 million, sort of in the middle of 2021. that refinanced 2 existing facilities that we had and left 5 vessels unencumbered. Has a nice revolver in it, 300 million at initiation to allow us to grow opportunistically, and obviously can be used for other purposes as well. Again, sort of the element and the basic strategy has been pay down the debt. We paid down over $200 million worth of debt, so almost 45% of our beginning of year balance, strengthen the balance sheet, and set this company up for sustainable dividends going forward.
Great, thanks, Apostolos. I'm definitely sensing a bit of a theme coming across. I think I'll pass on to Ted next, but and ask whether it kind of mixes things up, changing sectors slightly now. But definitely a few of the same terms coming through. So I'll touch back on those after Ted and James.
Sure. Thanks as well, Jasel, and thanks again to Capital Link as well. Look, we're all public company CFOs, and so capital allocation is the big theme. It always has been. It goes by different names at different times, but I think we share our colleagues' focus on it. Some of the dynamics are different. We've had a fairly good run even through COVID as a sector. The day rates and the measured by the Baltic have been relatively healthy, at times quite healthy. We've seen obviously different impacts from the Ukrainian tragedy. Not much LPG, really no LPG goes in by sea, but as everyone's talked about, the watchword now is energy security and changing trade flows. And so that's something that we're certainly very mindful of. Russia's not a big exporter. They only export about 6 million metric tons a year, about half by rail car and the other by MGCs out of Ust-Luga near St. Petersburg. So the direct impact hasn't been much, although there is a need to get more LPG into Ukraine because they do use it some, without taking away from Poland, who also uses some. But all that's kind of set up for a decent, trading environment for us. Again, no one wants to be profiting in someone else's misery, but as everyone said, changing trade flows and short supply of ships in various basins can mean healthier rates. As I look back on the prior year, I'd say, like a lot of the guys said, we didn't quite enjoy we had a good year, but not the renaissance I'd say that the dry bulk sector enjoyed. Dare say they're the belle of the ball these days, along with containers. But we had a solid year. We returned a lot of capital to shareholders. We did a couple dividends, returned $80 million in dividends. At the very end, about 2 years ago now, we did a large self-tender offer, which returned $113 million in stock and reduced our share count by around 20%. A lot of that was enabled by cash flow, but also by a little bit of refinancing activity. We did do a refinancing right at year end. It was interesting for us because it was a new market. We, like some of the other guys, have obviously been active participants in the traditional Western European bank finance market. We've been very active users of the Japanese sale leaseback market, not the Genco institutional market, but rather the sort of Japanese owner market. And but a new one for us was we tapped into the American commercial finance market, and we did 2 ships with Bank of America. Was led by Bank of America, and a couple other banks were involved as well. And it was really it was a good execution. We refinanced 2 ships, freed up some equity. The interest rate was quite competitive. It was 3.78% fixed for 5 years, which now actually sounds really good. At the time it sounded decent, but now it sounds really good. And I should apologize to them for hemming and hawing because the rate went up by 3 or 4 basis points right at the end, and I wasn't happy. But that's all water under the bridge, given where rates have gone. So I think that's another interesting and, frankly, for me, overlooked potential source of capital. As we look forward, we only have one new building, and we've already paid for most of the equity piece, and we have the debt in place. So I think as we go forward, like everybody said, I think our mantra, like others, is cash cost per day. That's what we live and die by. OpEx in our shop, probably like a lot of the other guys, is fairly sacrosanct. You don't mess with the ships. You don't mess with safety. G&A, you do, there's obviously some levers you can try to pull there. And then you've got interest and principal. And so I think my focus will be over the coming years, finding out ways to maybe term out our debt some more. We don't have any maturities until 2025, but always good to maybe term out some debt with obviously longer dated assets and hopefully drive down the cash cost per day a little bit. And, we'll also continue to return capital to shareholders when we can. We announced a couple, I actually neglected to mention, we announced 2 sale leasebacks last week as well, which are more in the line of our traditional Japanese homes. And we'd sold one of our older ladies a little while ago. So, we've been active in looking at different ways to change the balance sheet and ensure the best cost structure from a go-forward perspective.
Great, thanks, Ted. And it's interesting to get slightly different perspective in terms of sector. It wasn't planned at all in terms of having the different sectors and almost grouped together in that sense. And James, kind of moving on to touch on the tanker sector, obviously to some extent the rougher ride for you against the panelists on the call. So how have you found the last few months, year, and things changing for 2022?
Thank you, and thanks to Nicholas and Capital Link for having us. Difficult, I think, is the best word. I'm envious of my counterparts on this panel. 2021 has been a transformational year for these companies. Hopefully next year Scorpio Tankers will be in a similar position to my peers here on this panel. But I think first I have to thank them, because after so many challenging years in shipping, they are generating significant cash flow and have done a great job allocating capital. They've reduced their debt, increased dividends, bought back shares. And I think this is great for the shipping industry as a whole. But for Scorpio Tankers, the last 6 quarters, not even the last 4, were probably the most difficult in the company's history. COVID had a serious impact on personal mobility, which really reduced refined product demand and rates for our vessel. Despite these challenges, the company did not raise equity. So we've been very, very active on the debt side. We have about 35 different facilities. To maintain liquidity, which was our goal, we refinanced vessels, we increased our leverage, we issued unsecured notes, baby bonds, and we did an exchange of our convert. And our goal is really has been to maintain liquidity in the event that the recovery doesn't take or takes longer than we expect. Recently, we sold some vessels. This reduces our overall debt and boosts our liquidity. But our view for the year was really that, oil and refined product demand should improve each quarter, right? As we get out of COVID, people travel, start commuting, going to work, see friends and family, and then this should improve throughout the year. Recently, and really prior to the Russia-Ukraine conflict, we started to see an improvement in rates on our vessels. But certainly the impact of the Russia-Ukraine conflict has accelerated the recovery in rates here. It's to be determined if this is, the start of the longer recovery we've been waiting for, or if it's a short kind of recovery, and then we see that after. But I think the next step for Scorpio Tankers is really to reduce the leverage we added, when times were tough, and do it through scheduled amortization and maybe proactively in other areas. We've refinanced our upcoming maturities for the next 2 years, except for one facility. So I think for us, it's really, about putting the company in a good position, executing. We don't have any new buildings on order, and kind of just working our way through this part of the cycle.
Thanks very much, James. And it was interesting. I was making a few notes as each of the panelists were speaking, and funny enough, there were several words that were mentioned by each and every panelist. That included refinancing, repaying, reduce, deleverage, and a number of terms along those lines. So it's I don't know if anyone managed to catch the Ship Finance, the bankers' perspective panel earlier in the morning or earlier in the afternoon European time. But it was interesting towards the end of that panel discussion to hear that that the banks are open for business and welcome and willing to lend, which wasn't always the case 5 to 10 years ago. And interestingly, our CFOs on the panel are talking repaying, deleverage, reduce. So that kind of brings me on very nicely onto the next topic, in that seeing that the types of refinancings, deleveraging, share and loan note buybacks, and the kind of the various approaches being taken. It very much seems that less is more, and I think it's that topic that I wanted to kind of throw to the floor and ask, is that the new approach? I mean, obviously, there's been a lot of difficult years where that has led to efficiencies and being more conservative in those approaches. Is that the way forward? Apostolos, would you like to jump in there in terms of that topic?
Yeah, sure. I mean, for us, it kind of always has been that case. Obviously, I think that, choosing the right option amongst the different alternatives that the panelists mentioned depends on the point of the cycle, right? There are points in the cycle that you do want that higher leverage, which is going to give you a bigger liquidity piece to potentially bridge you to better markets in cases, or allow you a little bit more firepower if you think that you have an uptrending market. Other times, a lower leverage profile might be more attractive. I think that, if you think about it fundamentally, the goals of your financing should be get the lowest cost possible, get the most flexibility possible, maintain capacity, and build relationships. For us, we've worked very much in building those relationships, and while being able to pay down debt and improving the balance sheet, it has allowed us to sort of achieve all of those things while sticking to the traditional commercial bank market without needing to go to any of the other alternatives. I mean, our refi, $450 million, $300 million revolver at L plus 215 at the bottom of the grid. So, it sort of ticks each one of these boxes. And after having paid back almost more than $200 million worth of debt, we don't have any mandatory amortization until the end of the maturity of the facility. So we have managed to stick with a more traditional bank financing while getting some flexibilities from some other potential instruments like a bond, for example, right? But also get the flexibility and the ongoing relationship building with the bankers. So, again, I think, just to recap, it depends on the point of the market. But, ideally, if you can get that low pricing, high availability and capacity and flexibility, that's the goal.
Yeah, I agree with. Go ahead. Sorry.
No, go ahead, Ted.
I'm just going to say, I mean, I absolutely agree with that. I mean, it's, I think the first rule of capital markets that I learned at some point in my misbegotten youth in investment banking was you raise capital when you can, not when you need it. And I think that's really consistent with Apostolos is saying, because look, the banks go through cycles, and I echo the sentiment. We really focus on maintaining those relationships and doing business and trying to move, fee business where possible to our commercial banking friends, because they are all so good these days at calculating per client returns and profitability. It's important to me that we're seen to be a profitable client. I say I don't want to be your most profitable client. I don't want to be your least profitable client, but it is really important. And so. But in view of the fact that sometimes the bank markets are open and sometimes they're less open, from our perspective, we like to have access to a couple different markets. But again, really do like to work with those traditional European lenders because they're good partners through the cycle. They're smart, they're sophisticated, and they're good folks to deal with.
Just to follow up on that, I suppose I'd throw this question to either Stavros or Simos. I mean, I did notice that in each of the panelists going through kind of the latest activity that there seems to be a bit more of a pick and mix of the variety of on the debt side. It seems that it's not just the traditional bank debt that's there. Everyone seems to have a much more diversified debt portfolios than ever before. Is that what you're seeing? Is that a change that's happened over the last few years at the tougher times? Is that something that you think is likely to continue? I mean, the one thing that Ted mentioned was the relationships. I think Apostolos too. That there are some key relationships, and clearly those will develop. But having been through tougher times and potentially brighter days ahead, how does that change your approach? Your approaches to having different types of debt instruments, and as Ted mentioned as well, you're using capital markets.
Well, Jasel, I think it's exactly what Apostolos said. It really depends on the point of the cycle where you are. I remember it was less than actually 2 years ago when COVID started, basically, where all of us, without knowing how the situation is going to develop, the first thing that we have had on the top of our agendas was at that time to refinance existing facilities, to increase basically the leverage of the companies, and make sure that we could have the company survive for longer period under the situation, the restrictions basically of COVID that we were seeing early in 2020. Less than 2 years after that, in early 2022, the situation is exactly the opposite, basically. As you said, less is more. We are trying basically to delever and strengthen the balance sheet. We are in a tightening market, and basically we are selectively basically focusing the relationship on the tested relationship that we have with our financiers that can provide actually the most competitive terms, lower costs, and reduce the overall cost of the platform. This relationship basically have been validated in tough times back, during the last decade, and we believe that they really make the difference and should be basically further cultivated today. Overall, I believe that all the panelists that you see today have sufficient financing options through different tools, but primarily on a tightening market, I believe that on top of our agendas, in dry bulk, should be the deleveraging and strengthening of the balance sheet.
I can't agree more to what both Simos and Apostolos said. I mean, I love it coming to panels like this and saying that we are 40% levered and all our debt is scrap finance, is scrap covered. But indeed, I mean, this has not been always the case. And we're not shying away from the fact that in more challenging times for our markets and for our company, we have resorted in alternatives that are offering higher leverage, longer amortization profiles, or no amortization at all, like convertible notes, junior mezzanine non-amortizing loans, which come at a cost, but they serve a specific purpose. And indeed, in 2021, what we did was a flight to quality on all fronts. I mean, we have replaced all these legacy and expensive financings with more boilerplate structures. And on the corporate finance front, I mean, we did several buybacks of old legacy equity-linked instruments that were burdening our capital structure. This enabled us basically to deliver a cleaner investment platform to our shareholders and enhance their present and future returns. And indeed, the lessons learned from the recent past, they made us all approach leverage a bit more cautiously than what we did in the previous cycle. I mean, you cannot go in. If you look back what was happening in 2006, 2007, 2008, everyone was chasing the values of the vessels and were leveraging up. I mean, creating more liquidity to grow, to create more scale and to pay out dividends. It's not the same this time. I mean, we're approaching things more cautiously. We're looking at our break-evens. We want them to be sustainable in every market. And basically, we aim to continue going forward, maintaining the same approach on leverage. And as Simos said before, I mean, this will allow us to return capital to our shareholders under almost every market environment. And maybe, I mean, not resort to such more levered and more expensive solutions or alternatives in the future.
You had the easier part of that question, having come after Apostolos and Simos. So I'll ask you a follow-up question, Stavros. So interestingly, when I'm speaking to on the bankers panel, I'd often ask them, you know, what would they look for in their borrowers? But I'll ask you, what do you look for in your lenders?
I mean, we're trying to balance between flexibility, basically, and cost. That's what we're trying to do. And that's why you see us transacting both with experienced shipping lenders, although the structures are a bit tighter. I mean, in terms of the profile that they're looking for and the restrictions that they put in terms of covenant, the restrictions that they put forward. And then, I mean, we do a lot of leasing with Asian counterparties, be it Japanese or Chinese, and not so much on the Genco side, as Ted said before. I mean, mainly with Japanese owners in between, and depending on what we're looking to achieve on the pricing, on the profile, and on the leverage front. I think that the landscape that has been currently formed in terms of financing alternatives, it will still be around, give or take a couple of European banks that will be less active or will be exiting the market, and a couple of new or more Chinese lessors that are emerging or ramping up their activities. So that's what we're looking for. I mean, the perfect combination, if there's such a thing, between flexibility in the structures and competitive pricing. Great,
thanks, Stavros. We'll run out of time fairly soon, so I'll probably try and fit in one last topic, which I think links to, you know, having a little bit more firepower. One thing that was mentioned was obviously the low order book on the dry side specifically. But also, you know, the sale and purchase activity, which James mentioned, you know, whether as a tool to deleverage or you know, or otherwise. So on that topic, and in terms of how, you know, each of the panelists see, you know, the sale and purchase side, or, you know, increasing on the new building side, and I think that's a topic that I'd like to touch on, and I suppose, you know, ultimately linked to growth. But we'll start with you, James, on that, and then I think I'll pass to Ted after that. How do you see the sale and purchase side? And you mentioned obviously the transaction that Scorpio are looking to complete.
Yeah, so we're obviously not looking to buy ships. We actually announced a sale of 3 vessels today, or this morning, and also 14 a few weeks ago. The vessel sales for us do a few things. It illustrates the discount our shares trade relative to our net asset value. So we've seen asset values increase substantially over the last 12 months. And obviously with the dry bulk companies, for example, the cash is accruing at the same time. So you've seen those share prices really go up, but we hadn't seen much movement there. The second is that it reduces our overall leverage. Keep in mind, we do give up some operating leverage when we sell a vessel, but it does reduce the overall leverage of the company, and it increases our liquidity. And then that really sets us up for flexibility, which is something we need. So what we've had to do is increase our debt in the more difficult times through sale-leaseback transactions, which give you a higher advance rate than, for example, your traditional bank lender. But essentially, we finally reached this point at Scorpio Tankers where we have kind of see the light at the end of the tunnel. The market's starting to improve. And with these vessel sales, we increase liquidity by about 250 million. And what we'll also do in the first half of this year, which we haven't been able to do, is reduce our debt. So we're going to reduce our debt by around 500 million in the first half of this year. And that's a great stepping stone for us, because as this market improves, we will be able to show investors. So I think for us, it's really a show me, don't tell me story, which I think is really important. And we can execute on this plan to delever and then have more tools, whether it's following the dry bulk guys where, you know, share prices increase. So you go the dividend route. If the share price is lower, maybe buy back some stock or proactively delever, but it will be in a great position to actually have the capabilities to do that.
Right, Ted, did you want to jump in there?
Yeah, I'd say I agree with everything, you know, James had to say. His points were exactly well taken in terms of the effect on hopefully share price, in terms of proving your NAV and liquidity, and of course the offset is the operating leverage. In our little world of VLGCs, it's been rather interesting. There has not been a real arm's length sale of modern tonnage ever, and so modern tonnage for us is anything built 2014 on. There's been a very active market in the next generation. We sold 2 of our ships, 106, 108 built. Some of our peers have sold some 06, 07 and younger, older tonnage. So we sort of have this 2-tier market, and so it does put some pressure on price discovery, unfortunately, for investors and for us as management trying to articulate the value proposition. I would say that's part of the reason that you know, we've amped up our dividend payments, because you know, if you can't prove the asset value, at least you can improve your total shareholder return through dividend payments. So our world's a little bit different. I think showing investors the power of those markets.
Great, thanks, Ted. And we're into the last few minutes of our panel discussion. Time flies when you're having fun. So the last part that actually Apostolos mentioned, I'll open it to each of Apostolos, Stavros and Simos, was the new buildings and the order book. And just kind of general views on that. But I suppose one aspect that I wanted to also mention is that that phrase that I've commonly heard from bankers, which is that it only takes 10 years to forget the mistakes we made last time. So referencing the order book, I'll hand over to Apostolos and your views.
Yeah, I mean, thankfully we're still far from the 10-year memory loss mark, but never say never. I think that look, at the end of the day, outsized returns always find a way to correct themselves. I think it is inevitable for an order book to, you know, eventually start building up, but at the very least, right now we do have good visibility over the next 2 to 3 years. And we have various elements of uncertainty, you know, including geopolitical events, including choices of the next propulsion of choice, including other environmental regulations that are coming into play. So all of these things hopefully will keep a lead in this potential overinvestment period and keep the returns outsized for a little bit longer here.
I couldn't agree more. Basically, I believe it will take us more than 10 years to basically to forget the mistakes that have been done in the past. Obviously, there are still new mistakes to be made, but you know, both the uncertainty around new environmental regulations, the fact that basically thanks to primarily our container peers, the yards are full until you know, end of 2024, and it takes, you know, more than 2 years, potentially 3, for a new building delivery. Will keep the, you know, the dry bulk market tighten for you know, the foreseeable future. And you know, I believe you know, leaving black swan events aside, we have learned from the mistakes that have been made in the past, and we will not see, at least from our dry bulk, public peers, similar mistakes with, owners running to place new building orders like there is no tomorrow that we have seen in the past.
Stavros, you have the last minute for any final thoughts on that topic.
No thoughts, only a huge thanks to our container peers that continue, taking over the yard capacity. So there's not much left for us in dry bulk, and we love it. Continue, guys. There's much appetite for us to do things on the second-hand market, and there's still lots of uncertainty on the environmental front. When the time comes, we will be ready, and there's lots of untapped liquidity connected with decarb funds and sustainability loans and green projects that we can use to finance, our new buildings when the time comes. But for the time being, and for the next 2-3 years, a huge thanks to all our container peers.
But that's probably one of the people that's missing from the panel is a container company CFO. But clearly
they're busy ordering.
They're busy placing orders for new buildings.
Counting. But Apostolos, were you going to add anything there, or?
No, I think Stavros covered it pretty well there. Just a big thank you to the Capital Link. I see Nicholas jumping up on the screen as well. So nothing else from me.
And thank you to each of the panelists on the call. We probably didn't get through a quarter of the discussion topics that we had, but please, the discussion was there, and I'll head back to Nicholas now.
Well, thank you to everybody. It's been a great panel, and thank you very, very much, all of you, for joining, and Jasel for moderating it. Thank you.
Thank you.
Thank you, Nicola.